Everyone wants yield, but they're stuck in a zero-yield environment. And the place investors have found yield, dividend stocks, has become a minefield, with companies announcing dividend cuts nearly every day, reducing payouts and yield. However, one ETF seeks to pay a consistent annual distribution rate of 7% the fund's net asset value come rain or shine. The StrategyShares Nasdaq 100 Index ETF, HNDL, is the only fund that commits to a 7% yield. In an era where the federal funds rate effectively sits at 0% and the 10-year Treasury note pays a yield of 0.7%, income investors have sought yield among the usual suspects: dividend stocks, preferred stocks, closed-end funds, real estate investment trusts, REITs, master limited partnerships, MLPs, and the ETFs that hold these assets. Most of these products have seen their yields surge as their share prices fall, some even into double digits. However, total return is what matters to investors. It doesn't do them any good to receive a 6% yield if the fund loses 20% of its value. In addition, one of the rules of dividend investing is beware of high yields, as they could signal a company in trouble about to cut its dividend. The NASDAQ-100 HNDL Index ETF is a fund of low-cost funds that follow two indexes in a 50-to-50 ratio, giving the portfolio long-term growth and stability. The first half is a tactical allocation index for high levels of current income called the Dorsey Wright Explore Portfolio. It holds the largest, most liquid and least expensive ETFs in 12 categories: dividend stocks, preferred dividend stocks, utility stocks, growth and income equities, covered calls, active fixed income, intermediate-term corporate bonds, mortgage-backed securities, high-yield bonds, master limited partnerships MLPs, real estate investment trusts REIT, and taxable municipal bonds. The other half is the core portfolio, which provides long-term exposure to the U.S. fixed income and equity markets, with allocations fixed at 70% bonds and 30% stocks. It holds three large-cap blend equity ETFs, the three least expensive aggregate bond ETFs, and the least expensive NASDAQ-100 Index ETF. Both sides of the index are rebalanced monthly. Then, like a closed-end fund, HNDL boosts its return by throwing in a little leverage equal to 23% of the portfolio. If after all that the dividends and bond income doesn't produce enough cash to fund the distribution, the ETF employs the tactic of return on capital, the money investors put into the fund, which has the added benefit of lowering an investor's tax bill. Bonds are obligated to pay interest to bondholders on a regular basis, but there's no obligation for a company to pay dividends. When revenues dry up, as they have in the pandemic lockdown, companies may realize they don't have enough cash flow to pay all their expenses. In order to save cash, dividends are often cut or eliminated.